Hey, welcome back to YT Finance, and today we are going to be going over the best companies and the top stocks to buy in November. We're going to be talking about companies that are trading at a discount right now, companies that are going to give you dividends, as well as growth companies that are going to make you money even during a stock market crash or recession. In the first article that we are going to be analyzing, it's titled 2 Unstoppable Stocks to Buy on the Dip in November. After that, we're going to move on and we're going to talk about 3 Warren Buffett stocks to buy hand over fist in November, and then lastly we will conclude with 3 of the top best growth stocks to buy in November of 2022. So for more videos like this one, and if you want to know the stocks that I am personally buying, remember to go and smash that like button right now, comment your thoughts down below about some of the companies that you want me to report on, or the stocks that you are buying right now, subscribe for more videos, and without further ado, let's jump right into today's stories. So the first company we're going to talk about is Palo Alto Networks, ticker symbol PANW, and then we're going to follow that up by talking about Zscaler, ticker symbol ZS. Both of these companies are involved in the cybersecurity space, and this space is absolutely critical for the corporate world, even while the economy is slowing down. Both of these companies have been delivering fantastic results over the last 12 months, and I think right now is a good time to buy both of these companies depending on your personal risk tolerance, or at minimum, just go ahead and add them to a watch list until you do your own research. Both of these companies provide very unique and specific cybersecurity services and or products that the corporate world is going to need even during times of a recession, and that's according to Morgan Stanley. Morgan Stanley basically says that even though the market is crashing and that the economy is pretty fragile right now, corporations are still going to desperately need cybersecurity products and or services that are provided by Palo Alto Networks and Zscaler. Also, both of these companies have their Q3 earnings report, which will be released in the middle of November, so I'm very excited about both of these companies issuing their results because I believe both of them are going to have very positive results in terms of their earnings per share as well as their revenues. Currently, Palo Alto Networks, ticker symbol PANW, is trading for $169.65 per share, while professionals believe this company should be worth anywhere between $165 and $274. I personally think that this company could fall in their stock price past their earnings report, but the long-term fundamentals of this company are absolutely phenomenal, and that's why I personally hold them in my portfolio. Palo Alto stock is literally one of the leaders in the cybersecurity industry, and their products and services literally are the number one in 11 different categories, each of which are a subset of their 3 main core specialties, which would include cloud security, network security, and security operations. In particular, though, we would want to focus on their cloud security because the cloud is a particularly lucrative opportunity for this company and many others. On top of that, this company is also growing their customers at an astounding rate. For instance, at the end of the fiscal year of 2022, which was June 30th, Palo Alto had 1,240 customers, each of which are spending around $1 million or more annually, which increased their overall revenues and caused it to jump by 25% year over year. On top of that, this has helped them generate $5.5 billion worth of revenue for that fiscal year, and this also represented a 29% increase compared to the fiscal year of 2021. Clearly, this company is rapidly accelerating, which is why we've seen a pop in their stock price. Now, their business and growth is accelerating. However, I do think the stock price could pull back a little more before this company truly decides to pop off. The main reason I say that is because currently the company is heavily investing in themselves in terms of growth and innovation, and that is coming at a cost of their overall profitability. But in fiscal 2023, analysts and professionals believe this trend could reverse to where their profitability could absolutely explode and greatly improve, which is what I'm waiting for. So this is a phenomenal company, but I'm personally waiting for 2023 to invest into it, but because the company has already pulled back so drastically, I think this is a good time to start dollar cost averaging, or at least nibbling at this company in November of 2022. Lastly, I want to say that Palo Alto Networks is a praised stock amongst Wall Street professionals, with no single analyst actually recommending to sell the company. All of them are either saying to buy the company or to hold the company, and that speaks volumes about the future growth potential and the long-term growth that this company could give their investors. Next, we're going to talk about Zscaler, ticker symbol ZS, and I personally think this is a good buying opportunity right now. The current stock price trades for $153.50 per share, while experts in this area believe the company should be trading at anywhere between $160 on the low end and $500 on the high end. Zscaler literally is a pioneer in the respected space, specializing in cloud computing technology. And as large organizations migrate toward the cloud to enable their workforce to work from virtually anywhere in the world, this is going to come with particular cybersecurity problems that Zscaler can solve. That's why I personally like Palo Alto Networks and Zscaler, which both have shown a fantastic acceleration in their growth and innovations during the year of 2022 so far. Now, more information on Zscaler. They are financially a solid company that is growing very quickly. For instance, Zscaler's revenue topped $1.09 billion, causing it to jump by 62% year over year, making it one of the fastest growing stocks in their particular space ever since the company became tradable on the open stock market back in 2018. So clearly the performance of these companies in the past have been phenomenal, and I do think that the future of these companies are very bright. And for Zscaler, trading at around a 50% discount in their stock price as of 2022, this could be a great opportunity to buy the dip on these stocks and hold these companies for the long term. Now, with that being said, let's move on and analyze our next articles and stocks, which are 3 stocks that Warren Buffett personally owns in Berkshire Hathaway that other investors are buying hand over fist during November because the stock prices have pulled back. The stocks in this particular article are going to be recession-resilient stocks that could end up outperforming the overall stock market for the foreseeable future, and I also personally own these companies in my portfolio. The first one we're going to talk about is Bank of America, and they have a dividend yield that they offer investors for just holding their shares of 2.37, which is pretty solid. The company itself also has upside in their stock price appreciation, because right now the BAC shares trade for $36.16, while analysts believe this company should be worth anywhere between $32 and $55, so arguably it's undervalued on top of a pretty solid dividend for stable, consistent growth, even while the current stock market is falling and if we are entering in a recession. Some of you may think, why would we buy a financial institution company while the Fed is increasing interest rates? Wouldn't that hurt financial companies? The answer is yes and no. If the interest rates increase, this will actually expand their overall net revenues in terms of their interest net revenues. And I also want to tell you exactly what this article says, so I'm just going to quote from it right here, which says, although Bank of America is likely to make far fewer loans within the next few months than it has during the past few months, the net profitability of those loans should be much greater than the bank's current loan portfolio. In a recent interview with Yahoo Finance CEO, they pointed out that continued increases in interest rates could add another $1 billion worth of profitability to the company's current bottom line. That would bolster net interest income that was already up 24% year over year last quarter, end quote. And that's exactly what I'm alluding to. These increases in interest rates, even though the overall amount of loans will decrease, the profitability of these loans would skyrocket, and it would have an amazing positive impact on their overall net interest income. On top of that, the company and stock market has had a recent sell-off of around 40% back since its peak in February. This is why I think right now could be a good time to buy this ticker, especially as we head into November. The next company we're going to talk about, which is also a dividend yielding company, is Coca-Cola. This is one of Warren Buffett's all-time favorite companies to own, and this particular business is doing phenomenal even during our recessionary environment. Last quarter, they had organic revenue growth of around 16% based on a 4% increase in unit volume. This essentially means that they are passing along their higher costs due to inflation to their customers, and their customers are still buying their products. Coca-Cola is looking at solid single-digit revenue and earnings growth over the coming years, and this is going to be despite negative macroeconomic headwinds. So it really doesn't matter the current macroeconomic environment, this company is doing phenomenal. The KO shares are currently trading at $60.67, while analysts believe this company should be trading at $59 at minimum, which is very close to the current stock price, or $76 at maximum, on top of giving investors a 2.92 dividend yield, which is very solid. So even if you're not going to make money from the stock price appreciation, you are going to make money due to the dividend growth and the dividends that they are going to be paying out to you. Now, I personally think that both their dividends will grow on top of their stock price appreciation, which makes this company so good. Coca-Cola is literally one of the world's most recognized, beloved brands, and it's been in business for over 136 years, so it has had plenty of time to create a phenomenal customer base on top of just being a solid company with strong fundamentals. The company also has a lot of non-soda drinks that it gives to its consumers because predominantly they are known for their soda beverages and soft drinks. However, they also own a water company such as Dasani, Gold Peak Tea, and Minute Maid juices, just to name a few, but their portfolio is absolutely expansive. On top of that, they have a reliable dividend growth to where the annual dividend payment has increased year over year for the past 60 years in a row, making it one of the strongest dividend aristocrats on the stock market. Lastly, Warren Buffett loves American Express, ticker symbol AXP, and unlike its competitors such as Visa and MasterCard, which provide payment processing platforms for their card users, American Express does that on top of it has built its own robust charge card ecosystem, which arguably gives them a competitive advantage over their competition such as Visa and MasterCard. Now, for full transparency, I own all three of these companies because I don't know which one is the best, but I do love all of them because they have all returned phenomenal growth over the last decade. On top of that, American Express also gives a dividend yield of 1.29, and their current stock price, I think, is somewhat undervalued, even though professionals in this space believe the company should be trading at $128 at the lowest and $220 at the highest, while the current stock price, again, is $150.15, which is a phenomenal buying opportunity. On top of this, the company also gains revenue and earns based on interest income like any other lender, but it also generates a great deal of its revenue from card and services fees, which gives them even more income. So overall, this company is extremely resilient and solid even during a time of recession, and all three of these companies give you a pretty solid dividend. Even while the stock price is falling, you're going to be getting paid in dividend payments, but I don't even think these companies are going to fall much. I do think these are going to have fantastic rebounds in the long run, so that's why I really like this company, and I like Warren Buffett's investing style. Lastly, we're going to talk about three growth stocks to buy right now in November of 2022. And we're going to start off with one of my all-time favorite stocks, which is Alphabet, ticker symbol GOOG, which is the parent company to Google and, of course, YouTube. The current share price for GOOG trades for around $95, but analysts believe the company is undervalued because it should be trading between $115 or $160. Google is literally the world's third most valuable brand, and out of all of the companies on the NASDAQ, Google arguably has the best competitive advantage due to their monopoly over internet searches in Western countries. Alphabet as a company is anticipated to deliver double-digit percentage annual growth over the long term and very impressive earnings, to where their price to earnings ratio is only 16 times, which is shocking for a company as innovative as Google, and that's why I am adding to my Google position in November. The next company we have is Block, ticker symbol SQ, which is a fintech company which currently trades for $61.15. Block, according to analysts, should be trading between $49 and $175, but I think Block is a great buying opportunity due to the relatively cheap accounting ratios that it is trading at compared to other fintech companies, which are financial technology companies. Block, in my opinion, is basically like buying PayPal before PayPal absolutely exploded. Block's technology is not only superior, but also more simple to use than other fintech institutions, depending on the fintech that we are talking about. Despite macroeconomic issues in the economy, the company's stock price has fallen very drastically, but Block has still grown very steadily ever since they became public. As Block introduces new products and new ways to buy, sell, or pay later, the growth of the company and the growth potential is expansive. Block is currently trading at a 52-week low, which is a great buying opportunity for long-term buy and hold investors such as myself. On top of that, it's only trading at 2 times their sales. That means its accounting ratio of its PS ratio, which is their price to sales, is only 2. This is insane for a company such as Block, which is a growth stock, to be trading at a PS ratio of only 2. That is really, really cheap, and right now is a great time to buy this company if you are a long-term investor. So it's very intriguing. If not, do your own research and add this to a watch list. Don't necessarily copy what I do. Always make sure to do your own research. Lastly, we're going to talk about Airbnb, which currently trades for $113.55, while experts in this space believe the company should be trading between $100 and $197. Airbnb is a very famous hotel-like home rental offerings company that also gives you the opportunity to buy and go out and have experiences. Airbnb, ticker symbol ABNB, has fallen around 35% during the year of 2022, where investors are saying that this company could be a good buying opportunity right now, even during the current macroeconomic environment. The stock price has been beaten up, but I think the long-term growth of this company is worth looking into or potentially buying. Airbnb, from a technical standpoint, in regards to their finances, has very impressive growth and margins, and I think the company could continuously expand. The company is reaching international customers to where its revenue jumped 91% year over year in terms of their international revenue just in the first 2 quarters of 2022, and I think this will continue to compound out. Despite the shares being relatively high and this company, yes, is trading at a premium, it is worth considering a potential buy in this company, or at least starting to nibble at it like one of the other stocks I went over in this particular video. So that would conclude our list, and I would love to hear your thoughts down below, so go ahead and comment if you already own these companies, what you think of these companies, and if you want more videos just like this one. Go and smash that like button right now, subscribe if you are new, and I will see you in the next YT video.